Here's 3 growth stocks for you to look into that have somewhere between a 2 and a 4x potential upside over a multi-year span. Okay, I'm not talking about short-term trading. I don't talk about short-term trading on this channel. I talk about long-term investing. Somewhere between a year at bare minimum and even maximum 10 years or even your lifetime. So these companies over the next few years, I do believe have about a 2 to 4x potential. Let's get it rolling. Before that, my name's Austin. Thank you for being here. Thank you for being one of those 140-ish subscribers we have. If you're one of those, thank you so much. If not, go ahead and hit that button. As a thank you for doing that, here's a picture of both of my cats. Millie is the gray one and Luna is the brown one. They're absolutely beautiful. Thank you. Hope you enjoyed that. Let's get into it. There's 3 tech companies that all happen to be growth companies that I do believe have about a 2 to 4x potential. Let's roll into it with the first one being SoFi. SoFi Technologies, which is ticker symbol SOFI, SoFi. They're sitting at a market cap of about $5.2 billion. And this company is now a bank. They do a lot of student loans, they do a lot of personal loans, they have credit cards, they now have savings and checking accounts that offer hugely high interest rates, like highest that you can find out there, period. And in order to get these, you have to enable direct deposit into your account. So it's genius for them to put that little caveat in there like, hey, dangle this carrot in front of your face. You could get 4% interest on your checking and your savings if you just have direct deposit enabled. Anyway, they also have a huge back end. They're trying to become, they've said it before, the AWS of the banking sector. And I think Chamath Palihapitiya, who was a big investor and brought this company public, had said that in the past too. They want to be the back end of banking, especially for all the neo banks, to help out the infrastructure and do the payment handling. And the way they did that was they acquired a company called Galileo. This has been a great growth driver underneath the company that is going to allow them to have a huge competitive advantage over their peers. Okay, let's talk about the metrics here. Like I said, market cap 5.2 billion or so. And in terms of a price to sales, just looking at a few statistics here, price to sales sitting at a 3.13. But a more important metric to look at for bank stocks, which SoFi acquired Golden Pacific Bancorp, they are now an FDIC insured bank. A more important metric to look at is price to book ratio. I've done multiple videos talking about SoFi's price to book versus JP Morgan's price to book, and it's at about a 50% discount from a price to book standpoint as it relates to JP Morgan, with way more growth. SoFi has been sitting around 40% growth. It's very natural and normal for a company's growth to slow over time, slowly and gradually. So they might go from 40% to maybe 39%, down to 37%, but 30% growth is still massive. So if they can hold that 30%, even 25% growth over the next 3 to 5 years, this company is going to grow into an absolute beast of a company. One big thing that's hurting them is that they are not profitable on a GAAP basis. They're not profitable on a non-GAAP basis. So earnings per share have been negative. Good thing about earnings per share right now is that they're trending in the right direction. Q3 2022, they were at 9 cents negative EPS. And then the last 2 quarters, they've been at negative 5 cents EPS. But they've beat estimates on that every single time. So the estimate was lower, more of a loss than they actually reported. So they're trending in the right direction. Once they get to that profitable stage on an earnings per share basis, net income basis, this stock is going to soar to the moon. That's my opinion. That price to book ratio is not going to stay as low as it is right now, less than a 1 price to book. They're going to command a premium valuation over their peers and over the banking sector in general because of how much crazy amount of growth they have. Just speaking on that growth real quick, revenue growth for the current quarter is looking like 35%. That is the best estimate from 6 analysts that covered the stock. 35% revenue growth this quarter, 21% revenue growth next quarter, and then for the full year, averaging about 28%. If we can get the student loans to actually come back and not be in forbearance anymore, this is also going to be a huge tailwind on this company, pushing it forward. It's going to increase the revenue and increase the profit because student loans are stupidly profitable for this company. So next year, we're looking at about 26% estimate. And when we're talking about earnings surprises, they've had some great EPS surprises, as high as a 44% beat on EPS. I can't wait for this company to get to profitability. And on the last conference call, they were talking about they could have their first EPS positive quarter in Q4. That would be super awesome. I do think they're baking in the fact that the student loan forbearance is going to be over by that point. I don't know if that's true or not. They didn't say, hey, we're banking on this. That's just my assumption, is that they're assuming that student loan forbearance is going to end finally and people are going to have to start paying their student loans, which means they're going to get a lot of refinances, because SoFi was getting a huge chunk of their revenue from student loan refinances before the COVID student loan forbearance went into effect. Before we move on from SoFi, let's take a quick look at the balance sheet, because as Peter Lynch says, no investment decision is final without looking at the balance sheet. So we're looking at total assets of 22 billion, but I want to specifically focus on cash and cash equivalents. So we've got $2.4 billion in cash right now, 2.4 billion in cash. The market cap is only 5.1 billion. That's a 50% cash to market cap ratio. That's wild. So I'm liking that so far. I love to see that. Let's look at short-term liabilities. Short-term liabilities, current debt for this company, zero. Absolutely no debt on the books right now as of Q1 2023. That's amazing. When we're looking at long-term debt, two things that are not great. One, long-term debt is increasing quarter after quarter. I don't like to see that. And long-term debt's sitting about 6 billion in comparison to the market cap of 5 billion. So I definitely want to see that come down, but I do think it will start to come down as the company gets closer to profitability, because they can use some of that 2 billion in cash that they have to start paying down some of that long-term debt. This company is very, very well run. Anthony Noto, the CEO, is killing it so far. He has done a great job telling the story of where SoFi is going to go over time, and he has absolutely delivered in terms of the numbers. I can't wait for this company to get to profitability. Looking forward to that over the coming quarters. All right, let's move into the next stock here. This is also a tech company, much bigger market cap on this company. This is Shopify. A ticker on this is SHOP. Shopify, you know about Shopify. They're the drop shipping legends. Everyone has a Shopify course on the internet, and they are going to tell you that you can make $1 billion off their Shopify course if you just do these 3 steps. Okay, anyway, not hating on Shopify people. They're on their grind, okay? $78 billion market cap on this. This company is also negative EPS right now. So if you are scared of negative EPS companies, I don't blame you. Just something to look at. Checking it out on first thought. Looking at a few of the other metrics here. The forward PE looks hilarious because this company is in the process of turning that profitability corner. So the forward PE is 5,000 right now. So obviously that is ridiculously, hugely high. But as the company continues to have EPS growth over the coming years and gets to profitable on a quarter in and quarter out basis, obviously that forward PE is going to come down in a substantial way very quickly. Price to sales 13, price to book 9. Both those are high. I'm not going to lie to you. This company trades at a very high valuation, but it's because of the growth and the opportunity that is baked into this company. Absolutely amazing. They had a lot of growth pulled forward from the shutdown of the economy over the COVID times, but still revenue estimates in terms of growth, 25% in the current quarter. That will be the June 2023 quarter, 17%. This is 34 analysts covering this stock. Next year, still close to 20% growth. I do think they can pass that 20% growth mark, but here is the really awesome part. Their earnings, their EPS. This company is going to be a margin story and a profit beast over time. Already so far, they are beating EPS estimates by, this is the last 3 quarters so far, 70%, 800%, meaning they were expected to do negative 1 cent EPS. They had positive 7 cent EPS. That's amazing. And then 125%, they were profitable again with 1 cent of EPS in the Q1 2023. Current year, we're looking at 31 cents EPS. Next year, we're looking at 52 cents EPS. Based on estimates, that's about a 70% increase year over year in profits. That will be massive. That would help this company move up in a massive way. And a lot of people do not invest into unprofitable companies. I think it's very possible that Shopify blows these EPS estimates out of the water, because in their most recent earnings, they went from an asset heavy company. It seemed like they were trying to go after the Amazon model of having warehouses and trying to have a logistics service where they have trucks driving around and helping you deliver your products that you're selling on the Shopify store. They decided to sell their ownership in their warehouse and their shipping company, the logistics side of Shopify that they had just recently acquired. They decided, you know what, we need to go an asset light model. We need to go the huge margin opportunity rather than the huge revenue opportunity. So I'm really, really glad they're going the margin route, and I'm not sure that the EPS estimates that they've got here are actually accurate to what this company is about to put up over the coming months. Now that they're an asset light company, it's going to be huge for them, and even more huge for this company could be if they do get to profitability, and specifically GAAP profitability over the next maybe 3 to 6 quarters, and it's regular quarter in, quarter out, positive EPS, positive EPS, so that their positive EPS on a yearly basis and their most recent quarter is positive. I can absolutely see this company being included in the S&P 500. It's such a massive market cap to not be in the S&P 500 already, 78 billion, and multiple months ago, it was way higher than that. So if we look at a 5-year on Shopify, this company was at $152 a share, which means its market cap was 3x of this. Do I think that was overvalued? Yes, disgustingly overvalued. This stock has been past a $200 billion market cap, and it's never been included in the S&P 500. This would be one of the biggest S&P 500 inclusions in recent memory. If Shopify can get to profitability, that's the story for Shopify. So if you are about to invest in Shopify and you can't see a path forward for profitability and massive margin growth over the coming months and years, I don't think it's the right stock for you. They're always going to have great revenue growth over the next decade, in my opinion. The question and what they have to prove is the EPS growth. And how profitable can they be over the next 3 to 6 quarters? That's going to be where the stock price goes. If this company's putting in beast profits and beating expectations, then the stock price is going to soar to the moon. And it's going to command that very much premium valuation that it has always commanded. If it can't hit those numbers, it's going to be in the toilet for quite a while. Okay, we're already down a lot. Over an 18-month span, it's been cut by like 70%. That's a horrible, horrible performance. But if they can't hit those EPS numbers, I can see this stock dropping way more from here. If they do kill those EPS numbers and they destroy those estimates and they're killing it quarter in, quarter out, stock's going to soar to the moon. So that's the story here. EPS growth is definitely the story for Shopify. For Shopify, let's take a quick look at the balance sheet. We're looking on a quarterly basis. The most recent quarter, we had 10 billion in assets, current assets 5.9 billion, and 4.8 billion of that is cash. Very respectable. When we look at total liabilities, they could pay off 100% of their liabilities right now with just their cash on hand. That is an amazing thing to see, and that's what I'm talking about when it relates to asset-light companies. They have current liabilities of less than $1 billion, 4.8 billion in cash right now. Long-term liabilities, 1.6 billion. Like I said, 4.6 billion. They could pay off 100% of their debt today. That's an amazing thing to see, and a very, very comforting thing as a shareholder to know that this company is well capitalized. They do not need to raise cash anytime soon, and they're not going to be in a dilution situation, so I'm not going to be diluted as a shareholder. They're not going to be taking on new debt. That's a great thing to see. So they can just worry about running the business to the best of their ability and increasing those margins, and this company is going to be in a great place over time. Last but not least, everyone's favorite growth stock right now, Palantir. So Palantir is ticker PLTR. This is a company that is sitting right on the cusp of data integration, data aggregation, decision-making, machine learning, and AI. That is the huge topic of conversation over 2023 so far, and I think it's just going to become more and more of that. And once Palantir's name can be put in with those like Microsoft, those like NVIDIA, those like Google, this stock's going to get a lot of respect. Kathy Wood also just started buying the stock again, which she had very interestingly sold out of all her shares after one bad quarter, and now she's buying back in again. She's an interesting individual. Anyway, 21 billion market cap on Palantir right now, and on an EPS basis, on a trailing basis, they are unprofitable. But huge news over the last 2 quarters for Palantir has been reaching GAAP profitability, and that's general accepted accounting practices. They have gotten a 1 cent EPS the last 2 quarters and 1 cent positive. I know that sounds like nothing, but it's a huge milestone for this company. And on their most recent conference call, they said they expect to be profitable every single quarter of 2023. They didn't say that they were going to commit to being profitable in 2024, but it's not super common for people to look out 4 or 5 quarters in the future. But to talk about current year every single quarter profitable, that means this company could be on track for an S&P 500 inclusion, just like Shopify, but I think they could get there way sooner because they've already got 2 quarters in a row of profitability. If they can get 2 more, that's a full year of profitability, and they'll be profitable in their most recent quarter. Those are some of the big things that get you included into that S&P 500 or in the talks for S&P 500 inclusion. That could be a big tailwind behind this company that moves it forward in a massive way. Looking at statistics, the price to book on Palantir and the price to sales on Palantir is less than that of Microsoft. And that is something crazy we love to see. All right. Of course, the forward PE and the trailing PE are not better in terms of the metrics in relation to Microsoft, but this company is just now reaching those early stages of profitability. Over the coming quarters, that could change, obviously. But I think it's looking very attractive when you look at Microsoft versus Palantir, and I do see them somewhat as competitors in the AI space. I know some people say they're not competitors because they partner together and they work together. Competitors partner together and work together all the time. They're still competitors in my eyes, especially in the AI space. Something notable is whenever you see a price to sales ratio and price to book ratio lower for a particular company, it normally means that there's less growth for the company that has the lower valuation, because a higher growth company typically commands a higher valuation, a premium valuation over their peers. But as it relates to growth, sales growth is somewhere in the 10 to 20 range. I think Palantir is actually going to have a re-acceleration of growth as we move out of this unfortunate recession time that we're in. But even in these recession times and all the other frustrating things with inflation that are going on, they've got somewhere between 10 and 20% growth, and they're on the upper end of that, closer to 20%. When we look at Microsoft, next year back to growth, 10% growth or 11% growth for Microsoft expected, but that's not compared to the 20% growth that Palantir is expected to have next year. So the fact that it's at a cheaper valuation than Microsoft with something around double the growth, and now they're profitable, I think this company is going to get more and more money flooding into it because a lot of people just refuse to invest into unprofitable companies, and I'm not mad at them at all. Let's check out the balance sheet for Palantir. This is one of the best balance sheets I've ever seen in my entire life. This is what attracted me to Palantir in the first place, and the fact that they were free cash flow positive from forever ago, even before they started to hit GAAP profitability. Here it is. So we've got 3.6 billion in assets right now. Current assets 3.2, cash and cash equivalents 2.9 billion. A lot of this 1.6 billion is in T-bills, treasury bills, and they're getting massive amounts of interest off this because interest rates are so high right now. And then the rest of that 1.2 billion in cash, sitting in cash. Total liabilities, less than $1 billion. When we talk about current liabilities, the majority of it is deferred revenue. Okay, so it's not even a liability at all. I hate how they have to put that as a line item for liabilities, but it is what it is. Current debt, 53 million. And let me be clear, it's not even debt, it's lease obligations. It's rent for where they have their offices. So there's no debt right now. They do have some payables, but they have way more in receivables than they do payables. And then non-current liabilities, 206 billion long-term debt and capital lease. 206 billion is all capital lease. This is ridiculous. So if you don't understand what capital lease is, all they're talking about is that's the rent for their office. So they have no debt. I'm telling you, this is no debt company at all, with 1.2 billion in cash and another 1.6 billion sitting in treasury bills that they could sell at any moment because those are highly liquid. Literally no debt on this company at all. The only debt that they have to account for is those capital lease obligations. That's so ridiculous. So it's just the rent to keep their offices. This company is very well capitalized. They are good to go. When we look at the cash flow statement, they have been free cash flow positive every quarter for all of the quarters that I've been invested in the company and a few before. And that free cash flow expansion has been amazing over the last few quarters, going from around 32 million in free cash flow all the way up to 182 million in free cash flow in the most recent quarter. A lot of that is from the interest on those T-bills, but can you blame them for using their cash in a genius way because they don't have to service any debt because they're a debt-free company? This is an amazing thing to see. I can't wait for Palantir's future. I think they're going to be profitable every single quarter in, quarter out for the rest of this year, even if that's just a 1 cent EPS every single quarter. If they can hold that this whole year and then expand that a little bit into 2024, expand that a lot into 2025, we're going to see an exponential growth in not only net income but revenue and of course stock price, which is what we want to happen. So let me know if you're invested in any of these 3 companies, Palantir, Shopify, or SoFi. Love all 3 of these companies. I think they're great as long as you're ready to weather the storm. These are very much high beta companies, and they're going to move more than the market. They're going to move up more than the market, but they're also going to move down more than the market. So you're going to have a strong will, strong stomach as it relates to these stocks. Big ups and downs. Anyway, let me know what you're doing out there in the market. Let me know if you're buying any of these 3 companies. If you think they're great, if you think they're trash, let me know in the comments. Thank you so much. Have a great day.